Welcome to the Smart Money Core Concepts. In this training, we're focused on market correlation. Just like human relationships, the markets interact with one another in a variety of ways. Sometimes they move together in harmony, whereas other times they go in opposite directions. Understanding these relationships and how correlations work is a very helpful step in making more informed trading decisions. Let's explore how some of these different market dynamics play out on a daily basis. Starting off with the foreign exchange market. The Forex market is one of the largest financial markets in the entire world because we can see several trillions of dollars moving around in a single trading day. So what are the odds that a market this large could actually move together? Well, let's find out. Since the foreign exchange market focuses on currency pairs, a Forex chart is essentially measuring the value of two independent currencies against one another. In this example we have on the screen, it is the euro valued against the US dollar on the top half, and then the British pound valued against the US dollar on the bottom. Looking from the left side to the right, you can immediately notice the similarities in the way that the market moves down, and then up, and then sideways. Both of these Forex pairs show similar trends, either rising or falling together in response to how they are being valued against the US dollar. This is what we can call a positive correlation. The market correlation here is also being strongly influenced by the movement that we're seeing on the dollar. Let's take a closer look at that now. In this chart, we have the US dollar index on the top and the Euro USD on the bottom. What do you notice amongst the peaks and valleys? I'm going to invert the Euro USD now so you can see it from a different perspective a little more clearly. Looking at the market this way, it's very easy to identify the correlation. Now, there are several reasons why this happens, so let's get into some of the specifics. The US dollar index correlates with most of the Forex market because of what the DXY represents. The dollar index measures the value of the US dollar against a number of major foreign currencies, such as the euro, Japanese yen, British pound, Canadian dollar, and the Swiss franc. The US dollar has also been the world's primary reserve currency since 1944, when the Bretton Woods Agreement was first formed. The Bretton Woods Agreement essentially created a new international monetary system that pegged major world currencies to the US dollar, which at that time was also convertible to gold. Even when former President Richard Nixon announced the end of the gold standard in 1971, the US dollar has remained the primary reserve currency due to its stability and the size of the US economy. To this day, the dollar is still widely used within international trade when you look at how commodities such as gold and oil are typically priced in US dollars. However, there has been increased competition from other countries to create more mutually beneficial agreements that do not involve the US dollar. The last reason we're going to focus on right now is the central banking policies and how they can significantly influence the global markets. The US Federal Reserve, that controls the interest rates, has a big influence on the flow of foreign investment depending on whether they're lowering or raising interest rates with the goal of bringing appreciation to the US dollar. Now, these market correlations are not just limited to the US dollar. So let's take a look at a few more examples now. In this chart, we actually have 3 different things that we're looking at. The Japanese yen on the left, the US dollar index on the right, and then the USD JPY currency pair in the middle. Looking at it from this view, you can notice that over time, the USD JPY Forex pair actually looks a lot more like the movements that we see on the Japanese yen futures. I've highlighted some of those key areas to bring your attention to, and I've also placed arrows on the dollar index chart so that you can easily see the differences within how price action looks over time. Next up, we have an example of the 3 US indices. On the left, there's the Dow Jones, the S&P 500 in the middle, and the NASDAQ 100 on the right. You can see how over time, all 3 of these markets have correlated relatively closely. However, sometimes there is a break in this correlation called divergence, and this can give us clues to consider if a possible shift in the market momentum is coming. You'll notice how on these 3 charts, the markets still do look mostly correlated. They were moving up, created a high, and then started to move lower very quickly. This is a great example of how divergence occurs because of the context of how the correlation broke. You'll notice I've highlighted a couple of different things. Firstly, bring your awareness to the candle that's highlighted in yellow. Now, this candle formed February 12th, 2020, and we can see that on the US 30, that was actually the highest point that the market decided to go. That was not the case, however, for the S&P 500 and the NASDAQ, as they each made a higher high about 1 week later before the move down happened. We're going to be diving even deeper into divergence in later lessons, but it is important that you're at least aware of it now, so that when you see something like this happening, you can pay a little bit more attention. Now, the cool thing about market correlation and these divergences we just looked at is that the markets are fractal. Just like how we can see different markets correlate with one another, we can expect that similar patterns will form, whether you're looking at minutes, hours, days, or even years worth of data. The same principles we use to identify correlated markets in divergence can therefore be used on both short-term and long-term charts. Now, here's a list of some helpful correlations to be aware of. This, of course, does not include every correlation that is out there in the markets, but it's a good reference point for you to begin your studies. For some positive correlations, or markets that generally are going to move together, we have currency pairs like Euro USD and GBP USD, the AUD and the NZD USD, indices such as the US 30, NAS 100, and S&P, or we can even see a positive correlation at times between a commodity such as gold, and if we see the gold price rising, we may also expect that the price on AUD USD could go up as well. For some negative correlations, or markets that generally move in the opposite direction, we have things like Euro USD and USD CHF, GBP USD and USD JPY, AUD USD and USD CAD, or even at times, we could see the price of oil go down and the USD CAD Forex currency go up. So there's that negative correlation there. You can use market correlation to diversify, to confirm trends, and to help manage your positions and hedge risk. Now remember, correlation, while it is a useful guideline, it is never a guarantee. So now that you're aware that there is more correlation inside of the markets, you're going to be able to approach the markets with a lot more confidence. Review your notes, and when you're ready, feel free to continue to the next training video.